Let's have a session on OCR Paper 2 for GCSE Business. So in this session, we're going to look at 8 big topics, and that's based on the advanced information. To remind you, the advanced information is very important you look at it. The link is below in the description box. So topic number 1, importance of quality. Very big topic to make sure you've got locked down. Let's just go through the benefits of good quality. Well, of course, additional sales, improved reputation, repeat customers, competitive advantage. And you might be able to increase your prices as a result of having better quality. Now, if you have not good quality, but poor quality, the issues that would come: refunds, recalls, reputation issues. Your staff might become demotivated. You might need to do additional marketing costs in the future as a consequence of those poor quality products. And of course, lower sales. Number 2, ratio analysis. So we're thinking about ratio analysis. It's gross profit margin and of course net profit margin. Now, gross profit margin is gross profit divided by revenue times by 100. It's expressed as a percentage. And if you need to calculate gross profit, which is different to gross profit margin, then you must remember the formula is revenue minus cost of sales. And you'll find it all on the income statement. Net profit margin. Net profit margin is net profit divided by revenue times by 100. And to calculate net profit, it's simply your gross profit minus your expenses. And again, you find this information all on the income statement. Benefits of ratio analysis. Remember, it's useful to compare to previous years, useful to compare to rivals, and it's useful for stakeholders being potential or existing shareholders. ARR, average rate of return, always an important quantitative skill to get locked down. Formula, average annual profit. Remember, annual means yearly. Average annual profit divided by the cost of the investment, all times by 100, and it's expressed as a percentage. Now, to calculate the average annual profit, it's just an average, so it needs to be the total over how many. In this case, we're doing the average annual profit, so it's the total profits divided by the years. So if you had total profits of £10 and that's over 10 years, then your average annual profit is £1. Break-even analysis. Click the link up there if you want to get more details on break-even analysis, but you need to make sure you've got this topic locked down in terms of if it's a qualitative question or it's a longer question. It's the usefulness of break-even analysis. Just to remind you of the key points: break-even benefits, able to understand the minimum number of sales required to break even, not make a loss. Also, by doing break-even analysis, you can estimate your profits at differing outputs. And additionally, it might be useful for a business plan. It might help you to get finance. But there's issues, there's limitations with break-even. The first is only based on predicted data. If it's a case study, who got that predicted data? Do they have experience? Are they a newbie? Because if they're a rookie, it might be an issue. Maybe they've calculated the numbers wrong. Question that. Also, break-even analysis has lots of unrealistic assumptions. It assumes your output equals your sales and there's no waste. That's clearly unrealistic. It also assumes there's no economies of scale. What happens if you're a growing business? You might be getting purchasing or technical economies of scale. And it also assumes that you've only used one price throughout. But we've learned about pricing strategies. That's penetration or skimming. And of course, it doesn't account for that. So lots of problems, lots of flaws with break-even analysis. Number 5, calculation questions. Remember those formulas. Profit equals revenue minus total costs. And if you have to calculate total costs is fixed costs plus variable costs. Fixed costs do not vary with output. Variable costs vary with output. And if you need to calculate the variable costs, well, the variable cost is your variable cost per unit, per one thing, times by how many things, how many units. 6, acting ethically. So ethics within a business is the view that a business is doing morally the correct thing that stakeholders consider fair and honest. Examples of being ethical: number 1, if a business were able to use sustainable materials, pay fair wages to employees, provide safe working conditions to employees, consideration of the impact on animal welfare or on the environment, and benefits, of course, improve reputation, it might give you a competitive advantage, give you brand loyalty, and higher prices as a consequence might be something you're able to do. But remember the ethics profit trade-off. Maybe as you become more ethical, it might, in the short term anyway, impact your profits. Number 7, impact of interest rate changes. Now, this is particularly poignant because interest rates have, of course, been increasing over the last period, albeit quite slowly, but they have been increasing. So when we're thinking about interest rate changes, it's the impact on 1, producers, and 2, consumers. We'll start with producers. Producers are just firms, it's just the business. So if interest rates were to increase, it will make it more expensive to borrow money. This will greatly impact those businesses that rely on overdrafts and loans, essentially those businesses that have debt. And this will lead to higher costs, and clearly higher costs leads to lower profits. Now, higher interest rates will make investments in capital such as machinery more expensive if a loan is being used. This may reduce businesses' investment levels. Now, that's the impact on producers. This is the impact on consumers. That's me and you, people that buy stuff. If interest rates increase, it makes it more expensive to borrow money, but more rewarding to save money. And this will encourage saving and discourage borrowing. As a result, consumers will have less disposable income, so demand for goods and services will likely fall. The final topic is globalization. So globalization is the trend for countries' economies to become more interconnected. Now, the benefits of that for a UK business: it's easier to sell products abroad. You can locate cheaper raw materials or components, and you might be able to get access to cheaper labour. But the issues for UK businesses: it means increased foreign competition, and it will depend heavily on exchange rates. Click the card up there for more details on exchange rates. The final thing to say, this is the final sesh. Thank you for your support this year. Bye-bye.